Welcome everyone to the second week of our accounting course. In our first week, we talked about most general concepts that are applied in accounting, and also we studied current assets. And now we move on to another big class of assets, namely long-term, or oftentimes that is called operational assets. What are these? These are the assets that are used in the process of operations of the company and that are used for a long period of time. And for example, a machine. So you buy it once and then this machine works for, let's say, 10 years. It does require some fixed maintenance, maybe requires some upgrades, maybe requires some changes of big parts, but still it's used for a long period of time. Now, for the first time, we produce this long period of time. Why is that important in accounting? Well, remember, when we talked in the first week about major concepts of accounting, we talked about the idea of a period. So, a long-term asset, and as we further discuss long-term liabilities as well, these are the ones that in their life they cover many periods. And that creates some challenges with respect to the proper recognition of costs that are associated with these assets. So let's start with some classic definitions. So again, operational assets. The major idea is that they are used in operations. And what is important, they are not designed for a sale. So basically, if you're a trading company, you buy and sell some goods. And when you buy them specifically to later resell them, maybe with some changes, maybe with something added to that, but so these will go to our inventories. However, when you buy the machine that packs them up, this machine works for a longer period of time and it's used in operations, and the machine itself is not for resale, well, unless you're a dealer in packaging machines. Then this changes. So you can see that what is, let's say, an operational asset for one company may be not an operational asset for another company. For example, if you build equipment, if you're an equipment manufacturer. So in this case, let's say you make special drills for oil companies. So for oil companies, these drills will be operational assets. For you, these will be just inventories. Well, that's a clear distinction. Now, there are several major types of operational assets. And these include, first of all, tangible assets. So these are the ones that are also oftentimes called property, plant, and equipment. And they are physical, they are used, all pieces of equipment, let's say machines, various kinds of special production equipment, they all fall here. Now, so these are the first type. The next one is natural resources. Because, for example, if you have timberland and if you make plywood, then this timber is natural resources for you because you always use that as a raw material. And it's, unfortunately, when you use more and more, then unless, timber grows faster than you use it, then its value goes down. And finally, a very important area, and it's especially important right now, when we live in the age of the new economy, this is intangible assets. Well, clearly by their definition, you cannot touch them. But these include various things, patents, property rights, and others, and these are identifiable. I'll put like this. So you cannot touch them, but you can identify like how much they cost and for how long they. For example, all intellectual property rights, like my rights for this course, for example. This is a classic intangible asset. And then there are some other intangibles that cannot be identified, especially that goes for goodwill. We talked about that, just touched that in our previous courses. But for now, we can say that this becomes an asset only at the time the company is purchased or sold. We talk much more about this special asset in our next course that is devoted to mergers and acquisitions. But for now, this is a very special kind of asset that basically says that why can a company enjoy such a nice demand for its products or its services? And that is because people know this company as a nice producer of these goods and services. And that is depicted by this goodwill. There are special ways to value that, but they are somewhat more or less subjective. So these are the definitions and the types. Now, here I would like to draw a diagram. So this is time. So this is the purchase point of operational assets. And mostly we talk about tangible here. Then we bought it, then prepared, and at this point we started to use it. Start of so-called useful life. Now here, for whatever reason, this is the end of useful life. Well, maybe it you cannot anymore repair it, or it just became obsolete. And maybe here this is a point of disposal. If you sometimes you stop using that, but you can sell it at some price to someone else. So this is useful life. Basically, this is the amount of time when you use this asset. And now, when you purchase that, then you have the idea of cost, which is kind of important here. This is the cash equivalent of what you paid. Then plus insurance, transportation, installation, or some other. For example, if you bought a very special mainframe computer, you may have to build the special area in which it has to be installed. You maybe have to install specific cryogenic equipment there. So part of that can be incorporated in this cost, and that cost later will be somewhat, in a certain way, allocated over the useful life of this asset. So if we went back for the moment for our corporate finance course, remember we said that the assets in corporate finance are just black boxes that produce cash. To some extent, we can say that these operational assets, they contribute to the cash generation process by these assets, because we also use, raw materials, labor, and something, but we also use these machines, because oftentimes we cannot transfer these costs and create a new product that is in high demand and has some value unless we use these assets. So that is the main idea. So we can say that operational assets contribute to the cash generating process. And the main reason why we put so much emphasis, because we study these operational assets for this and 3 more episodes, is that they play a very special role in our major idea of valuation of companies and projects. Because of this long period of useful life, we have a big question. How do we recognize, or sometimes they use a special, allocate parts of cost over time? And this is a big question, And that leads us to the main idea here. And the idea is the matching principle. So here I'll be very brief to tell you that what if we just recognize the full cost of a piece of equipment immediately? Let's say we purchased a very special machine for $5 million. That would serve for 10 years. But we would say that we immediately recognize the full cost of $10 million this year. Why is that wrong? Because in this case, we have huge cost this year, but then in the years 2, 3, and then up to 10, we'll be sort of quotedly using this equipment for free. That really does not produce the best estimate or true income, because actually we use part of the cost of this equipment every year. So let's say we can say if it's $5 million and if it goes for 10 years, a better approach would be to take 1/10 of its cost as an expense each year. $500,000 for first year, second, and so on and so forth. So this leads us to the overall idea of depreciation, the process by which we recognize these costs of equipment over its useful life. Here, depending upon the type, we use different terms. So we say that for any kind of an asset, we create the income statement expense account. And this is for tangible assets. These tangibles may be of two special kinds. This is land and then PPE. I just forgot to mention land before, but land is also clearly a tangible asset. But for land, there is no expense. So historically, we believe that land stays the same over time. Well, this is not true. Sometimes land can be improved, sometimes it can be spoiled, but this is the way it's treated in account. For property, plant, and equipment, that is called depreciation. Now then, for natural resources, it's called depletion. When your mine is getting depleted, so first there was a lot of gold and then at the end it's empty. And then finally for intangible assets, this is called amortization. So all that general approach leads us to the idea of, I would use depreciation as the major term here, and the question is how exactly we approach this allocation and why is it important for us, first in accounting and second in valuing projects and companies.